Hi, I'm Mark with Arlington Hall Investment Advisor. As a business owner, you should understand how to add an outside partner. And just like we've served up a tip to avoid landmines for your business in the past, whether it was not hiring a successor who is a mirror image of yourself, or making sure you have protection from rogue employees, we will now offer you a tip on how you can both add an outside partner and not lose money in the process. Let's recap. We've suggested your to-do list as a business owner needs to include sell my business. Step 1, create a culture that rewards solid performance. Next, transition key employees to owners. We reviewed how to protect your firm and your client relationships during this internal succession planning. We reviewed the structure for selling via external transition planning. Before we walk you through a full transition, let's introduce one concept that's grown in popularity: keeping control of your company but enlisting an outside partner to come on board. For example, this might be someone who is very familiar with your business but not on the payroll. How do you evaluate an outside partner candidate? Does the individual qualify to be an owner? What is the candidate's revenue and asset contribution, reputation and new business development ability of the candidate, professional achievement, credentials, skills, leadership and managerial experience, character, philosophy, and fit? While you're at it, develop a deal you can offer to internal candidates too. Don't admit anyone, employee or outside, who does not fit your strategy and philosophy. A way you can make sure that you don't act in haste is consider an employee arrangement before a partner arrangement to make sure the economics and the fit are right. You can buy their business, merge it in, make them an employee, and allow them to buy in when they qualify to be an owner. Or you can allow them to retain rights to their client base during the trial period, then use that as currency when they qualify to buy in. There's a good reason you don't want to act in haste. Adding an outside partner could result in you losing money. Now we're going to explain how you can avoid a landmine for your business by adding a partner but losing money for yourself in the process. So how can you add an outside partner and their contribution and still lose money? Consider the following hypothetical example. The cash flow is, say, sales are $5 million minus salaries of $2 million leaves you with $3 million of variable profit. Take out another, say, $1.4 million for fixed costs, and you have a profit of $1.5 million. Now let's bring in our new partner, who will bring in, say, $1.2 million of new sales. So the new partner's added revenue divided by your firm's gross sales is 1.2 divided by $6.2 million, or 19%. After doing the math, we learn without adding an outside partner, your firm's partners earned $625,000 before, and they each earned $526,000 after the partner joined. You don't need to write down those numbers. Just know it means you and your partners will lose almost $100,000 in annual income after adding the partner who is bringing in $1.2 million of new business. Do the math to make sure you make money for all your effort. So after you fix the math, what are the components that belong in an external partner agreement? The agreement of ownership transition should define how the two practices will be valued in order to establish ownership structure, what decision-making power will be given to the new owner, and what the changes will be for the existing owners. How the combined firm will make future changes in ownership, the compensation method for all owners, including salaries or any other forms of base compensation, incentive compensation, and ownership distributions. Also, protective provisions such as non-solicitation agreements. For instance, do the new partners' clients become clients of your firm after they join, or are they restricted and exempt from a non-solicitation agreement? So check if your financials are in a state that will allow for a meaningful valuation. Does your compensation permit others to be added? How about your new partner? Can you articulate why it's a good investment for them? All of this will help you shed light on whether your new partner candidate should be a contributor or if they are partner material. Study the facts before you make a decision. You'll be thankful that you did. Consult your advisor or hire an advisor to discuss your specific circumstances, or click Contact Us to chat, or click Learn More if you'd like more information to study. Make it happen.